What's ailing the Indian market? We have Sandeep Agarwal from fund manager and co-founder of Sovilo Investment, and Dheeraj Nim, economist and forex strategist at ANG Research, to dwell more into this. Gentlemen, welcome to the show. Sandeep, my first question to you. We have seen persistent selling for a few days, and what exactly is driving this downturn? Is this just a profit booking, or you are looking at it as a deeper correction?
Hi, good morning, and thanks for having me on the show. So, what we are seeing for last 3-4 months basically is that, there are two reasons. One, there has been a lot of uncertainty on the geopolitics level. Secondly, it is there that, the deal still has not been signed with the US. And finally, people chase performers. And if you see the emerging other markets other than India, whether it is Korea, Taiwan, they have done phenomenally well. And always we have seen in last 20-25 years that wherever there is performance, whether it is an asset class or whether it is a market, finally, money chases those assets and those markets. So that is the reason of, even gold, silver doing so well, because there is performance and people are trying to be on the right side of the trade rather than wrong side of the trade, even if it is short term or long term. Similarly, people are trying to be in markets where they can make more money. And now finally, because of this outflow, say consistent selling and outflow, the currency is also weakening, and that further accentuates the matter. So basically it is a kind of catch 22 where you are selling, currency is becoming weak, and again you are selling. So I think this vicious circle has to come to an end at some point of time, and probably the first positive sign will be this EU signing of the FTA, and this quarter numbers, honestly, till now, whatever has come, they have been quite good and encouraging. So I think finally earnings will come into picture, and the investors will start looking at earnings. And I think we have a massive underperformance in last 1 year. So generally, smart money will anytime start moving into the assets or the markets where there is value. So that is the way we look at the markets.
Thank you, Sandeep. Dheeraj, I would like to bring you in, and looking from an economic perspective on this overall situation, are we already in an oversold territory?
Look, it's hard to say that we are in an oversold territory or not. Remember, we got into the tariff shock on extreme valuation concerns for the Indian markets, and since then, most economic data, at least on the nominal side, has been under stress. Our nominal GDP growth has slowed markedly, and given the low inflation scenario that we're going through, it will only be a gradual process before that can recover. And I assume with that, along with that, other nominal measures, other earnings, etc., will also take a bit of a time to recover as well. And on top of that, we've seen a lot of currency pressure, as was pointed out earlier, which also, impacts the allure of Indian assets to a foreign investor. So it's hard to say if we are in an oversold territory because there's so many structural and cyclical factors at play. But as far as the economy is concerned, look, when we're looking at the underlying economic data, whether it's with respect to activity, etc., things don't seem to be as bad to me. I mean, even if headline GDP numbers could be overstating growth momentum due to methodological issues, we understand that growth certainly on the ground is around 6.5% to 7%, which is very, very robust compared to where the other global economies are. And even more encouragingly, it has been improving in the last couple of months. So I think that, for the financial markets to settle a bit, it will take a while. But I think underlying the economy remains pretty stable and a pretty resilient one.
Okay, so tossing it back to Sandeep and bringing the discussion back to the equity markets. So Sandeep, do you think that the DIIs that are holding up as of now, because FIIs have been pulling out their money constantly, so do you think that DIIs have left more fuel to absorb this pressure for a longer term perspective?
So, what has happened in last 20-25 years, we have seen that, this script has been seen by investors for 20-25 years, at least 7-8 times. And they have always seen that when this kind of situation comes, after that, the way markets have given return after every such sharp fall has been phenomenal. And remember that when you sell, then also it moves, it shows wild moves because there is lack of liquidity, and on the upside also the same is true. So I think, now there are two things which are happening. One, the equity penetration is going up. So more and more people are coming into the system who wants to do SIP and wants to build generational wealth and long-term wealth and not 1, 2, 3 months, 6 months kind of return. And second, because this script has been seen by most of the investors several times in the last couple of decades, now people are not perturbed by it. So I think that yes, some month there could be a 5-10% fall in the money inflow which happens, but I don't see beyond that anything. Honestly, we run a PMS and we have not seen any kind of panic and all that. Investors are in fact for us also pumping money daily, and they show conviction that yeah, we need to buy at this times. Obviously, it is impossible to time the bottom. Whatever you buy, even any stock at any price, even after this correction, you will again probably have a situation where the stock will be down 15% from here also. But the fact is, if the fundamentals are strong, if the earnings justify that, then all these losses will be recovered in one day. We have seen, when on the upside also the mid cap and small caps do go up 20-30% in one day. Like, it is very quick move. So I think, finally, wherever there is no froth and wherever there is a fundamental supporting growth, I don't see there is any challenge, and things will come back also equally strong.
So Sandeep, by this logic, are you saying that SIP right now is the way for an average domestic Indian investor?
So I would say that whoever is investing, whatever pattern, because we run a PMS, so I will not only say about SIP, but I would say that whoever is doing investment, they should continue. These are the right times, and that is the reason the concept of CAGR of 3 year and 5 year is there, because in those 4 or 5 years, there will be 1 year when you will lose maybe 10%, but the balance 4 years will cover that, and then the CAGR is calculated on a point-to-point basis. So I think, if we are able to do good CAGR over next 3 to 5 years, then obviously that is the number to be looking at, and not 1 year drawdowns and 1 year negative returns. And I'm very confident that our investors are very mature now. They have seen this so many times in the past, so they are not at all disturbed by it. And in fact, many of them are so smart, they have started treating this as an investing opportunity, and they are consistently participating in the market more and more. So I think this will pass too. Yes, the expectation of the investor has to mellow down, because remember that structurally now we are not a 7-8% inflation economy. Now we are not where the nominal GDP and GDP growth gap is very big. Also, our interest rates, I don't think, will be phenomenally high in future also, because most important import item which we have is crude. That I think that based on the global experts, it cannot structurally go up because of the alternate sources of energy coming into play. So I think we will have to also mellow. If our cost of capital is going down, then we also have to reduce our expectations. So if earlier people had 16-18%, 20% kind of growth expectation, given the new circumstances, we have to bring it down a little bit, because our risk premiums have also started going down. Leave aside last 2-3 months whatever is happening on the currency side, but generally with good fiscal deficit number and good low interest rates, I think definitely at some point of time it makes a lot of sense to bring down your expectations.
Yeah. So, Dheeraj, I'll bring this back to you, and let's talk about rupee now, because we are hovering near all-time low of 92 per dollar right now. So, is this triggering? Is this signaling towards a deeper macroeconomic condition, or how exactly are you looking at the rupee levels and the macroeconomy right now?
Look, like I said before, the fundamental economic growth momentum is actually very healthy in the economy. And when you look at inflation, for example, it is also very, very subdued. So, what you can possibly characterize as a bit of a Goldilocks situation for India. But the rupee is expressing the external account risks for India quite prominently so. And it has a lot to do with sentiment as well as the actual flows as well. So if you think about it, then if tariffs are going to stay in the picture long enough, then it's going to have an impact inevitably on our current account dynamics. While it's not going to cross any dangerous marks, I mean, it can very well remain below 2% of GDP, the current account deficit. It would certainly be larger than what we have seen in the last few years, when it was very subdued and very contained and very eminently fundable by other sources of the balance of payments. Now, along this widening of the current account deficit risk, we have also seen the net FDI into India dry up quite materially. And while it has rebounded a bit in FY26, the rebound has not been strong enough for the balance of payment to be in a really healthy shape. And on top of that, you have seen a lot of these equity outflows, capital outflows which have compounded the pressure on the rupee. So fundamentally speaking, even though current account deficit dynamic remains quite manageable and not so much threatening as a number, as a share of GDP, it is the funding that matters, and we need to have more stable funding for that current account deficit in the medium term for the rupee to be stable across the course of the business cycle. So I think that is where the stress is coming from, and hopefully once a lot of these external geopolitical uncertainties, etc., subside, there would be greater conviction in India's economic story, which has stayed resilient all through.
Yeah. So Dheeraj, at what level should an average Indian be worried looking at the rupee? We are already at 92, which is a level where RBI was comfortable till, because RBI said till 92 they would let the market determine the value of the rupee. So are we right now at a level where an average Indian should be looking at and getting worried about the economy, or how are you looking at the entire situation right now?
Look, I do not subscribe to the view that there should be panic or any of those emotions attached to the exchange rate. We have to understand that exchange rate is a price at the end of the day determined by market forces of demand and supply. And of course, Reserve Bank of India does its best to smooth out the volatility. We quite believe that they're right in saying, when they're saying they're not defending any particular level aggressively, if the fundamentals warrant a weaker rupee, then they would allow the rupee to weaken. And that is what we have seen happen in the last few sessions, rupee touching 92. Now, if the fundamental pressure on account of a widening current account deficit, equity outflows persist, and there is not a whole lot of speculative demand about the rupee, then I don't think the Reserve Bank would be averse to an even weaker rupee from the current levels. Right. And I think that is really the spirit of a managed floating exchange rate. Managed part is, of course, done by the Reserve Bank of India to prevent speculation, to prevent undue volatility, and the floating part is determined by the market. So, like I said, it's an exchange rate is a price. Then we have to take it as that, and it is reflecting a certain demand and supply of foreign currency in the domestic markets. Let that happen. Let that happen for a bit, and then see because these are money flows, some of which are hot money flows that can come back when the tide turns more favorable. And like I said, the story of India's economy has not really waned through all of these turbulences. So let's hope that better things will prevail in the months to come.
Okay, thank you. So Sandeep, bringing it back to you, looking at the valuations now, the market is the market right now stretched on valuations after the rally last year? How is the valuation picture shaping up right now going forward?
So, overall, if you see, then markets are not cheap. That is a fact, right? So we are I would say fairly priced. We are little better priced than what we were last year. But if you go into the details of the numbers, so there are many stocks, and so much of data is there on all the social media sites and all. Many companies in the mid and small cap, they have suffered very badly. Obviously, they were earlier trading at 20, 30, 40% higher percentage than the large cap. Even the PEG ratios were very high. Now, I think those all things have abnormalities have been taken care of. Things have come down to, but the reactions are always extreme on both sides. So earlier it was a story of very, very high, assigning very high multiple and lot of froth on the upside. And now I think there is a very, very high amount of fear, and that is the reason the stocks have corrected. Like, some of them have corrected more than they should have. And that is the reason market exists. It is same in currency, same in equity. So the people who have money and the people who can analyze and have confidence in long-term India story can buy. But I would put it this way, that, seeing the whole index in a simple PE terms will not help, because in our index, there are some sectors like the technology sector, the FMCG sector, where, growth has waned away very, very sharply. We are not seeing growth in those sectors, and still the PEG ratios for them are very high. So you have to do, normalization. You have to also exclude some sectors where the growths are decent, but multiples are very low, particularly the OMCs and all. So when you do that, then what you find is that, broadly, the correction has been more where, the growth is also high. So relatively, the value picks have not suffered so much. The growth picks have suffered a lot. So if growth comes back, I think that, those stocks are the ones which will fly first. And probably you will not see big impact on the index level.
Yeah. So, Sandeep, having talked about all the vulnerabilities in the market and the correction right now, where are those pockets where you are seeing safer bets in the current scenario?
So, we believe that, again, after very good years after COVID, where whatever you bought has done well. Now, in last 18 months, what we are seeing, and I think this will be the story for next 2-3 years at least, that market will be more bottom up, and wherever there is value, wherever there is growth. So it will be a stock specific market, very, very difficult to be a sector specific or broad market. So I think, pockets where we see tremendous amount of value is in manufacturing side, because 1 or 2 bad quarters and lower private capex and all those things, many engineering stocks which are very good stocks, and they have actually never traded below, let's say 20-25 times forward earnings. Even in 10 years, they are now available at 14-15 times. So, it is a meaningful correction in those names. They have fallen from 40 times to 15 times, while long-term averages is also 20-25 times, which include periods of aberration like COVID and all. So I think there is a tremendous amount of scope there. There is tremendous amount of scope in the recycling industry. There is tremendous amount of scope in the auto anchs. So there are pockets, and we will be more aligned towards manufacturing and BFSI right now, because we again believe that even in BFSI, you want this NPA cycle is at its best time, and you will not see any negative surprises there. So the PSU banks and the NBFCs, they all should do well. So we will now little shy away from the gold finances, because I think there is it has become too hot a sector to be. But we will be very keen to have manufacturing alignments and the recycling spaces and the BFSI space, particularly the NBFC and the PSUs.
Yeah. Dheeraj, now shifting focus towards Fed a little. If Fed stays hawkish, does that mean a prolonged pressure for India? And should households be worried about jobs and growth slowing down now?
So look, as far as the US Federal Reserve is concerned, the market view and our consensus, I mean, the market view and the analyst consensus generally is there perhaps a little more easing to be done by the US Federal Reserve. The key reason is that the US economy outside of the AI space is actually quite weak, and labor market has been flagging weakness successively in prints after prints, and that's broadly the trend, which means that the interest rate bias is still to the downside. We actually have the call of 2 more rate cuts, not in January, but perhaps March and June. So that staggered rate cutting cycle is still to continue. Now, the fact is that if things go the other way and the US economy surprises on the stronger side and the Fed has to turn hawkish, which everything else constant means the US dollar could strengthen and the currency pressure on India could sustain. I do not believe that that would have a direct implication on the Indian household finances or the situation of jobs and all, because at the moment it is domestic demand really, which is holding up the fort in India's growth picture. And we expect it will continue to do so given the spate of policy measures that have been taken by Indian policymakers in the last year or so, including the monetary policy easing, the tax relief by the government in a broad-based manner, so on and so forth. So we expect that, the policy impulse in India would actually be to strengthen and nurture domestic demand, and that would really become remain the mainstay of growth even in FY27. So the Fed's policy could certainly have pressures on the exchange rate, India's external account flows picture, which is already not looking great. But otherwise, I think the domestic economy policymakers will be able to save the day with timely interventions.
Yeah. Thank you, Sandeep and Dheeraj, for joining us on this very insightful discussion on a Saturday morning. Wish you a very happy weekend.